Often we talk about risk management and it's such a broad concept. In today's world, what does it mean?
Thanks, Loretta. I think in today's world, due to the sort of interconnected nature of countries, of territories, risk management has evolved. So in the last few years, the definition of risk management is far broader. We've got to consider concepts of political risk, concepts of IT risk, fraud risk. So I believe that the world's become so interconnected that it's really important to consider risk in a far broader context than it has been considered before.
And I think also the post-credit crisis, we've channeled risk perceptions into financial risks, a lot of issues around governance and fraud. What are global risks today?
I think there are a few very topical risks at the moment. Japan right now, for example, with the potential nuclear disaster, starts to have a far wider impact linked to the sort of interconnectedness of countries and territories. Take the example of the automotive industry, which is now impacted by the fact that the Japanese automotive industry may not be able to supply parts, etc., to the South African market. Okay,
so it's a lot broader. You mentioned IT risks, and this takes me back to events recently in the mining sector, where we've seen some Australian executives on trial in China and imprisoned for issues around corporate espionage, for instance. So where does IT come in helping you manage those risks?
I think the traditional definition of IT probably needs to be challenged a bit. And IT is more about information and data protection. It's about data privacy. It's about potential data leakage out of your organization, which really poses a huge risk if you've got data that needs to be protected in terms of customer information, personal information, and linked to that would be something like the bill, the Protection of Personal Information Bill, which needs to be adhered to and should be becoming an act quite soon. So I think particularly important is the IT and specifically data aspect.
In a country like South Africa, how do we define risk? Because obviously there are a lot of issues around governance. There are also a lot of regulatory issues too.
You've mentioned earlier on the concept of value, and I think that's quite important. Up to now, it's been considered as, well, top down, these are typically the risks for my organization, and this is how we believe we should manage them. I think it's a lot broader than that. It's linked to strategy. What is the strategy of my organization? How do I link in managing my risk to exploiting potentially the value that I could derive out of those risks as well? And there's an opportunity cost to potentially not exploiting those risks.
I mean, obviously investors, when they look at the South African market, they say, great infrastructure if you're talking about things like ICT, but huge deficits when you're looking at issues around skills. So as they make their investments, they weigh up those pros and cons. How do we look at the South African environment right now and assess which are the risks that are pervasive to a company's growth and which are not?
I think there are two ways of looking at risks. I mentioned earlier on the top-down approach. I don't think that that's outdated. So every organization needs to say, based on the institutional knowledge in our business, what do we believe the top risks that face this organization are? And I think that needs to be kept quite clean and short so that there's focus on those specific risks. Bottom up, relating to the political situation, relating to IT and fraud risks that might exist, governance, compliance challenges with legislation like King 3 out there, and meeting somewhere in the middle between the top-down and the bottom-up approach, I think would be a healthy sort of middle ground.
Compliance really and truly is obviously an issue here, and it's voluntary. You want to comply, you don't want to comply. Often the costs of non-compliance are quite high. Is that seen as a risk?
Up to now, the costs of non-compliance have typically been a slapper on the wrists. And I think shareholders are becoming far more savvy about risks, the need for risks to be very much linked to a strategy of an organization. So there is a lot more pressure from shareholders around how organizations should be managing risks, especially when there's a financial penalty, perhaps Competition Commission fines, which I guess have been in the media quite a bit lately. And that starts to erode shareholder value. And when shareholders are hitting their pockets, I guess it becomes a personal issue.
I mean, South Africa is becoming more and more regulated, and some would say that's a good thing. But in a week from now, we're going to be contemplating the new Companies Act. That's led to a lot of conversation, and also Consumer Protection Act. As shareholders look at this layering of regulatory factors, do they see that as problematic?
It's a tough one. I think there's a mix out there. If I look at the clients that I service, there's certainly a view that this is a good thing and it's been a long time coming, and we need to kind of beef up in these areas. In other instances, it's, clients find it constrictive and believe that we should be scaling back rather than increasing and applying pressure on a lot of these facets of legislation. Again, I believe there is a middle ground, and we've seen it in countries like the United States when Sarbanes-Oxley was out probably 9 years ago, of how initially it's quite a tight, regimented approach, and as time goes on, that middle ground becomes more apparent, and I think we will get there within the next 18 to 24 months.
Well, in terms of the elements that you've raised, the two elements in terms of cost, there's the cost of implementing a risk management strategy, so that's a physical one, versus the cost of non-compliance and not really working around this or not working with the system. If you had to evaluate those two costs to a company, how would you say?
I would say the costs of implementing a system or framework of managing risks are actually the negligible costs. And I believe that the really high costs potentially could be not exploiting the value through it, or the financial penalties that we mentioned earlier that could be imposed. So I think that the former is certainly the small cost aspect.
Now, at this conference that's taking place tomorrow, what sort of issues are you going to be raising?
Well, tomorrow's seminar is really based on education, and it's about, we call it the School of Risk Management at Deloitte, and it's really about the facets of risk management. It's about how to manage risk. Tomorrow's theme is specifically focused on Africa, education into the Africa region. And your point earlier on around, do we have enough skills? This is something that aims to address those skills, not just in South Africa, but in the broader African context as well.
I'm glad you mentioned Africa, because I mean that's the audience that we have on CNBC Africa, and clearly it's different environments depending on where you're at in Africa, East, West or Southern Africa. What's the sense about entering new African markets? Because also there the definitions vary. You've got emerging African markets, and then you've got fledgling states, frontier markets.
So Africa is seen as, I heard a comment the other day that Africa is seen as where China was 30 years ago in many senses. And I think it certainly is a melting pot right now. One of the considerations for the African market would be, again, understanding our risks before any forays into Africa. I read a report the other day from the World Economic Forum on 2011 global risks, and under that, political situations in Africa, in specific geographies, much of which, and this report was dated January 2011, much of which in the last 3 months has actually materialized. So I think the key point would be analyze what the risks and potentially the costs of doing business in Africa are before actually making forays into the African market.
Again, I mean, obviously Africa is not one homogeneous continent, and we all have different histories and different circumstances, but it tends to be that the biggest risk to Africa, as seen by investors, is a political risk element, and that's irrespective of the fact that we've got more and more democratically held elections. There's just a sense that Africa is this very complex political animal, and it's difficult to navigate at a bureaucratic and regulatory level, whereas others would say actually the biggest risks of doing business in Africa has less to do with the political environment and more to do with things like the stability of currencies and whether banks function well. Have we evolved in our thinking, do you think?
That's a good point. I think, unfortunately, Africa is often considered as a country similar to Australia, and I guess not in the component, perhaps, states that make up Africa. So I would say it differs dramatically across some of the regions in Africa. If you had to compare East Africa to West Africa, it's again knowing the geographies and territories. Even if risks do exist, if a political risk does exist in a particular territory, I don't believe that should be a precluding factor from investment or inroads into that particular area. I just believe that it needs to be managed and mitigated. So risk mitigation, probably another key concept.
Okay, and finally, I mean, a lot of these seminars, you have peers within the industry chatting to each other, and yet we're told what we really need more and more these days is partnerships between government, civil society and business. We need to have a more spread out conversation around issues that are important to the broader macroeconomic environment. How much more consultation is being done across the various channels?
Well, I think, Loretta, it's probably events like this where the most, I would believe, useful debate and discussion actually happens. Funnily enough, it's not during the classroom-based sessions. It's during tea and during the lunch sessions that you actually get to learn a bit more about perspectives out there in industries and share those experiences and tend to build relationships that grow even after the actual event.